Welcome back to our intermediate financial accounting class. In the last few segments, we've talked about a lot of cool stuff. Everything that affects retained earnings that we haven't covered already in closing entries and other basic discussions. We've talked about changes in estimate. We've talked about changes in principal. We've talked about changes in entity, at least part of it. And then we've talked about correcting errors. And we've gone through most of the process with correcting errors. The only thing missing is that very last step. Once I do my journal entries, what happens to my statement of retained earnings so that my investors can see what's going on? So let's take a few minutes now and review our Daglin example, and then we'll look at the statement of retained earnings. If you remember, Daglin had two distinct errors. The first was that we failed to recognize some interest expense in year 2. So we decided this was a counterbalancing error. And if the year 3 books were closed, there would be no journal entry at all. If year 3 is still open, we decided we did need a journal entry. We could go ahead and drop retained earnings so that it's down to where it should have been if we'd done the correct entry in year 2. And in this year, we wouldn't have to recognize the interest expense. We could get our year 3 net income back where we wanted it. Next, we looked at an example where they sold a machine at the beginning of year 2, and they didn't account for it. They just kept depreciating this asset that they no longer owned. We looked at what they should have done and what they did, and we realized there was absolutely no synergy. There was nothing right. We had to just start from scratch, and we made 2 sets of entries. One for year 3, where we were able to fix this year's depreciation expense and do a slight change to retained earnings. One in year 4, when the year 3 books were closed, where we still took care of all the permanent accounts, but we had to make the whole change to retained earnings because that incorrect depreciation expense had already been put into the retained earnings account. So you can see down here, retained earnings was debited by $6,000 for this machine instead of just the $1,000 loss. So we were $5,000 off. So by the time the books had closed in year 3, there was a big change that needed to be made to retained earnings. Now that we've done all of that, we need to take a look at a statement of retained earnings. We can see how it changes. Now, one quick aside here before we do the statement of retained earnings. A change in error or a correction of an error works the same way as a change in principle, meaning if I show multiple financial statements for the sake of comparison, I have to fix them all. So if I'm in year 4 and I fix these entries, I have my year 4 numbers with the updated retained earnings. I also have to fix the year 3 numbers that are right next to the year 4 numbers in my comparative balance sheet. So if I just change retained earnings, it's not going to be right. It's not going to balance. So I have to make sure I change everything associated with the journal entry, both for the year that I'm in, year 4 in this case, and in year 3 that I'm showing for comparison. If I'm in year 3, I would change year 3. I would also have to go back and change year 2. If I'm showing all 3 years, 4, 3, and 2, I'd change them all so that they were all correct as if I'd done it right from the very beginning. So just like a change in principle, simple entry, but multiple changes to the financial statement. So just be aware that there's a lot involved here to make sure things stay in balance. If you just change retained earnings, it won't balance. Let's go ahead and take a look at the statement of retained earnings for year 3, assuming the year 3 books are open, and then we'll do it again, assuming that the year 3 books are closed. So to help us out here are the numbers that we need. Daglin reported beginning retained earnings of $200,000, net income of $100,000, and dividends of $25,000 for year 3. And then net income of $300,000 and dividends of $50,000 in year 4. So let's go ahead and look at these 2 different statements of retained earnings. And let's start with the year 3 books being open. So this is Daglin Incorporated. Statement of retained earnings for year ended 12/31 year 3. We're going to structure this just like we did for the change in principle. This is retained earnings January 1 as reported. And we were told that we reported retained earnings of $200,000. Next, we're going to show a correction of errors. And like we did before, we're going to send them to a note. So let's say C note, let's just assume everything's in 14 this time. So what would be my correction of errors? Well, the way we figure this out is we go back to our journal entries if the books are open, and we look for the debits and credits to retained earnings. So let's go back to our journal entries. If the year 3 books are still open, we debited retained earnings for $500 in order to correct the interest expense. If the year 3 books are still open, we would have credited retained earnings for $2,000 because of the asset that we didn't write off of our books. Our adjustment or correction, we had the sale increased retained earnings for $2,000. We had the interest that decreased retained earnings by $500. So the net effect would be a $1,500 adjustment. So my retained earnings, January 1, as corrected this time instead of adjusted, would be $201,500. Next, I'm going to add net income and subtract dividends. Let's see, the dividend number was given to me. It was $25,000, and we were told the net income was $100,000, but we did some things that changed net income. So I can put in the dividends of 25. Before I look at net income, I need to take a look again at my journal entries for when the books were still open to see what, if anything, affected my net income number. Let's start here with my original net income. That's that 100,000 that we were told. And now let's take a look. For this initial entry, for the counterbalancing error, I would have credited interest expense by $500. So if I credit interest expense goes down, and net income, if interest expense goes down, goes up by $500. So let's go ahead and put that in there. Positive 500. Now let's take a look at the non-counterbalancing error, or the machine that we missed. And we're focused on the year 3 books being open entry, and we have a credit to depreciation expense. So depreciation expense would go down, which means net income would go up for $3,000. So my new or corrected net income would be $103,500, and that's what I'm going to use up here. So my retained earnings, December 31st, will be the $201,500 plus the $103 minus the $25 gives me $280,000. And that's what happens if the year 3 books are still open. What happens if the year 3 books are still closed? Well, things are a little bit different. Luckily, I still go through and just look at the journal entries to see what is different or what happened. So, statement of retained earnings for year ended. If the year 3 books are closed, then this would be the 12/31 year 4 set of financial statements. Retained earnings, January 1, as reported. And I'm going to have to stop right there because I don't know this number. All I was told was retained earnings at the beginning of year 3. So it was 200,000. If I hadn't fixed any errors or changed anything, I would have added $100,000 of net income because I hadn't fixed anything, 25,000 of dividends, and I would have shown 275 as retained earnings. If I hadn't fixed any errors or done anything in year 3, I'm fixing everything in year 4. So 275 would be my number as reported. Correction of errors, and again, I need to refer them to a note. So C note, let's see, this is a different year. Notes are usually in about the same place, but probably wouldn't be exact. Let's say that this is in note 13. So now we need to figure out the correction of errors. We need to go back to the journal entries that we made if the books were closed. So let's go back. So for this initial error with the problem to interest expense, if the year 3 books are closed, it was counterbalancing. It would have been corrected. I wouldn't worry about it. There's no journal entry. There's no journal entry. I don't have to make a correction because it's already taken care of. so I won't worry about that one. If the year 3 books are closed, I still do have an adjustment for the asset I should have sold. I had this credit to retained earnings of $5,000. Since there's nothing for the first error and $5,000 for the second error, I can do that in my head. 0 plus 5,000 is 5,000. So my retained earnings, January 1, as corrected, $280,000. I would never actually do this twice, once with the book open, once with the book closed. But since I have the numbers, I might as well use them. This is what I want my beginning retained earnings for year 4 to be with the corrections all made. It should match what I got as my ending retained earnings in year 3 if I'd done the corrections then. And sure enough, 280 here, 280 there. So I'm on the right track. Next, I'm going to add net income and subtract dividends. And again, I'm going to check my journal entries. I know there was no journal entry for the counterbalancing error, so I don't have to worry about that one. If my year 3 books were closed, the entry shows nothing that affects this year's net income. Why? Because it all flowed into retained earnings. So I didn't have to worry about anything changing this year's net income. If I depreciated again, then I would have something that was going on this year, but I didn't. So I have nothing in this journal entry that affects net income. So I can just use the reported number. Here it is, 300,000 in year 4 and dividends of 50,000 in year 4. Net income, 50,000 for dividends. And that gives me retained earnings December 31 of 530,000. Now, either way here, I'm good to go. Either I fix it in year 3 or I fix it in year 4. Doesn't matter. It all comes out the same. Either way, I end up with a beginning balance for year 4 of $280,000. And that's what I want. The only caveat, again, is if I change my retained earnings balance on my balance sheet without also changing the other permanent accounts, it's not going to be a balanced balance sheet. So make sure when you do these corrections, you change not only the retained earnings, but you change the balances in the other permanent accounts. And if you're reporting multiple years, you go back and fix previous years as well. So you have to make sure you correct everything so that you're showing what the books would have looked like if I never made the mistake in the first place. Now, we've talked about a lot of different things that affect net income and retained earnings and flow onto our statement of retained earnings. That's what we were looking for in this discussion, was to see what kind of things affect that statement of retained earnings. Because most of the time, retained earnings only changes with closing entries. But there are some decisions we make that affect retained earnings before that. So we talked about changes in estimate. That's an important change that happens to our financial statements, but luckily it doesn't change the statement of retained earnings. We talked about a change in principal that does require us to make some adjustments to retained earnings. We talked about a change in entity, and if we have errors that we have to fix from previous years, then again, we have to change retained earnings. So hopefully you've got a feel for how these numbers are going to change that third financial statement or fourth financial statement. We don't talk about the statement of retained earnings much, but it's a key piece to understanding and calculating all of the numbers that we need throughout our financial statements. And we need to make sure we're comfortable with how those numbers change. The good news about all of these changes is that there's no difference between US GAAP and IFRS. Everything we've talked about with these changes is converged. So what you see with US GAAP is also what we do with IFRS. So that's kind of nice, so we don't have to worry about differences. With that, we're going to wrap up this discussion. When we come back, we'll be wrapping up our financial statements and our discussion of intermediate accounting with one last topic, the statement of cash flows. Fun stuff. We'll see you then. Thanks.